Inside Options is brought to you by the Johannesburg Stock Exchange. Manage your risks with Safex style options.
Hello and welcome to another episode of Inside Options. Joining me as usual is James Boardman from the Equity Derivatives Division of the JSE. James, welcome.
Hi, Jane.
Today we're pegging everything on global markets going awry and looking at how derivatives can make you a profit from the fall of global markets, aren't we?
Well, they mainly use, as I said in previous episodes, you can use them for two different things: speculating, hedging, arbitraging. Now, mainly when we're worried about global economic conditions. I mean, at the moment, some of the news coming out around the world is quite scary. I mean, GDP growth in Germany is not looking good. The UMISH Consumer Sentiment Index in the States is looking really bad. Quite concerning conditions around the world. And in the past few weeks, we've had a lot of volatility in the stock market. We've seen Societe Generale, that's fallen like 33% at one stage, yes. And that's pretty scary. So around the world, people are starting to be a bit more concerned about their share portfolios. And possibly double-dip recession as well. Exactly.
Is there a way for the markets to predict? I know that they're not always related.
Generally, in a recession, stock prices do tend to fall. Depends on whether it'll affect us and come through to South Africa. Around the world, there's a saying that if the state sneezes, the rest of the world catches a cold. And that tends to be kind of true. So that's key, looking at the States. Also, if we look at our trade-weighted sort of basket for South Africa, our biggest trading partners are still the EU.
Yes.
So that's also a big concern. That slowdown in growth in the EU is quite worrying.
Time for us to start looking to the East, I think.
Exactly. So around the world, a lot of people, a lot of businesses are looking at the East, looking at Latin America. They're looking at South Africa as well. All these emerging markets are now sort of looking better investment opportunities than the developed world. So there is sort of funds flow, there's people talking about it, investors around the world.
Does this mean that people are then, as you're saying, looking at opportunities, still trading those big indices? I mean, the big main indices in the States, Europe, here and South Africa as well.
So let's just look at the concept of an indice, because that's what tonight's show we're going to be focusing on. We're going to be focusing on the top 40 index and the tradable derivative of that futures contract. We also have options on that. That's the ALSI, is what we call it in the future side. Bit confusing.
It's not the all-share index.
It's not the all-share index. It's the top 40 index. Now, that's a sort of historical anomaly, is that when we started trading futures on them, they were actually on the all-share. Now, as the all-share sort of sprawled in complexity, I mean, I think it's got some hundreds of companies in it at the moment, very, very hard to hedge that sort of particular basket. So what we moved to was the top 40 index. Now, that top 40 index became the FTSE JSE Top 40 in 2002, and that is what we base our futures contract on, is that top 40 contract. Now, that's our most liquid contract. We trade lots of futures on it. So let's just look at the concept of an index. What is a stock index? I mean, you've named some of the ones. There's ones in Germany.
Yeah, you've got the DAX, you've got the
CAC 40
CAC
in France.
And the London FTSE.
The FTSE 100.
You've got the NASDAQ, the S&P, and the Dow in the States.
So all these ones are quite interesting. The odd one out there that you mentioned is the Dow. Now, everyone looks at the Dow. It's quite an interesting one. It's different to most of the others. It's a price-weighted index. So each share has got a weight of one share in, and then they just add up the prices. So if you had a share that had a price of $800, but you had two shares in issue and you were in the Dow, you would have a massively disproportionate influence on the price level of the index.
Yeah.
And that's currently a problem with the Dow, is that it's quite misleading because one or two companies with very high share prices can have a big impact on it. What the rest of the world, most of the other major indices do, is market capitalization weighted indices. So that looks at how big a company is and the shares in issue. It says how big is its market cap, and we re-weight that index each quarter. So we have a quarterly review process with our indices team at the JSE, and they look at it, they talk to the guys at FTSE, and they re-weight all the stocks in it. So it changes the basket of what those top 40 stocks are, actually changes all the time.
But more objective?
Yeah, it is. It is more objective. It's less liable to sort of have big effects from one or two big share price companies. Right. Problem with the top 40 that a lot of asset managers come to us and sort of don't like is that it's got a very high exposure to resources.
I was going to ask you, we know that the top 40...
It's very heavily skewed towards resources because Anglo-American and Billitons are such humongous companies in relative to the size of the South African economy. Also because they're dual listed. So the question is, do we count their foreign listings? Do we only count the local free float? How do we sort of process that in there? There are quite a lot of interesting intellectual questions around that index construction. But together, the figure, it's probably changed quite a bit since then. I was looking at it was about sort of 18% is around about Anglos and Billies, just those two companies in there. So as Anglos and Billies do, so does the index. So it's quite an interesting index, but it's very, very liquid nonetheless. It's South Africa's most traded, most sort of looked upon. It's also used very often as a benchmark for fund managers. So that's how did the market as a whole do? Let's take a basket of these top 40 companies in little sort of proportions, and let's look at how they did and how the fund manager managed to do relative to just buying this basket.
Markets have been declining, but I know that you've been trading huge volumes at the moment. Tell us a bit about that.
Generally, for us at the JSE, volatility is a good thing. The more volatile the markets are, people are buying, people are selling, they're going up, they're going down. If there's a clear trend, then there's more trade. We make most of our revenue from trade, so the more sort of trade there is, the better our revenues tend to look. If the market's very quiet, nothing happens, no one's trading, no one's paying us trading fees, our revenues will look less good. So it's quite interesting to see the massive trading volumes we've been doing. At the moment, on the ALSI, we've got 219,000 contracts of open interest.
All right, let's take the concept of open interest a little further.
Okay, so
what exactly is
open interest means new positions being opened. When that number increases, means more people are taking a view on the market. More people are going. For each trade, there's got to be someone going short, there's got to be someone going long. For each trade, there's a long and there's a short. So there's one person saying the market will go up, there's one person saying the market will go down. Now that's kind of, as more and more people get worried about the market, generally the biggest end users of that will tend to be asset managers. They'll already be invested in equities, they'll have your share portfolio or your pension fund or unit trusts, and then they will go and sell some ALSI 40 contracts in the hopes that if the market does decline, that'll protect them. They're taking some risk off the table. It's a lot cheaper and easier to trade these rather than to go and liquidate your portfolio. The cost is a lot less because of the cash. So with an ALSI, you're taking on a position. At the moment, it's about 26,500. It's got a value of 10 Rand per point. So one contract is 265,000 Rand of exposure to South Africa's top 40 companies. If you were to go and trade that in the cash market, you'd have to pay out 265,000 Rand. To take on that exposure in an ALSI, you can do it for as little as about 20,000, 22,000 Rand, I think. Okay. At the moment is roundabouts where our initial margin is. So for 22,000 Rand, you get 260,000 Rand of exposure to the market.
All right, so it's the ratio aspect is there again.
So because of that, there's gearing, and they don't have to liquidate their share portfolio, which has very high costs. Moreover, if you were to trade the full basket of shares, you'd be doing lots of little trades in little bits of shares. Generally, you get to trade this whole thing for a very low price. At the moment, the exchange charges about 2.65 Rand for this 260,000 Rand of exposure. So you've got this kind of quite certain cost basis, and you've got a very big exposure and the ability to move lots of money in and out of your portfolio without actually having to physically move the money. You're sort of moving the money in parallel to your share portfolio, able to take some risk off the table or add risk onto the table.
Okay, James, we're going to leave it there for a second. We've got to go to a commercial break. We'll be right back to talk more about the risks involved, how to protect yourself, and then some of the seasonal phenomena involved in derivatives trading. Cool. Don't go away. We'll be right back.